Hello everyone, welcome to Akira's Academy of Accounting and Finance and welcome to 12th standard. I hope whatever you have studied in 11th standard, you still remember all those things, right? It was not like you gave your exams and you're like, okay, let's just skip it off. But for 12th standard or for accountancy, you need all those basic things, right? Okay, now in the 11th standard, we studied what type of transactions are there, how to give effects to them, and it was all about the sole proprietor. We learned how we will give the effects of the transaction for a sole proprietorship firm. Sole proprietorship firm means there is only one owner, single owner of the business. But now we are going to study about the partnership firm as well as accounting for the companies in your 12th standard. So today we are going to start about the basic concepts related to the partnership firm. Now when we say partnership firm means there is somebody along with us who is carrying on the business, and the person who is carrying along with us is called a partner. Okay, they are partners in the business. It's not necessary that if a father is running a business and if his sons comes and starts doing the same thing, if they are with him, that is not a partnership, right? There has to be somebody whom you have agreed, there is an agreement between both of you that you are the partners of the business. Now when I say partners, all the transaction which you did in your in your 11th standard, the effect is going to be remain the same. No such like whatever debit entries are there, credit entries are there, nothing, you don't have to worry about it. The same thing will happen in the partnership firm because they are going to carry on their business and there are certain transactions which are going to happen. The only thing that you have to take care in this partnership firm is how you will distribute the profit among the partners. Okay, in sole proprietor there was one owner who is bringing in the capital. In partnership there are two or more than two partners who bring in the capital. They are a part of this business and they they share the profit and losses among each other. So this particular chapter will deal with how you will give effects of all these transactions, right? We are not going to go through the basics of accounting entries, right? This entries we are going to do related to the partners' capital and how they will share everything, right? Now when I say partnership firm, what are the features, like what are the things a partnership firm hold? The first thing is there should be two or more than two partners. Okay, single person is a sole proprietor. Two partners or more than two partners is considered as a partners in the firm. Okay, they are partners and whole this collectively is called a firm. But there is a maximum limit also as per the Indian Partnership Act. Indian Partnership Act 1932. Okay, what is Indian Partnership Act? It is an act which has formed to carry out certain rules, okay, to govern this partnership firm organization. If anything is not agreed between them, how to resolve it, there are certain rules which have been there in the Indian Partnership Act 1932. And as per the Indian Partnership Act, there can't be more than 50 partners. If more than 50, it is considered as a company. So minimum to maximum partners in the partnership firm 50. Second is there has to be an agreement, okay, between those partners that yes, we have to carry on this business and we will share this profit or loss amongst each other, right? Now it's not necessary that there is a written agreement, right? There can be an oral agreement. They have agreed to carry on that business, right? The third is there has to be some business. If those two or more than two people are owing certain property or owing certain anything assets, and that is an investment for them, they are not considered as a partners. Okay, if they are carrying on the business of purchasing or selling the properties, that is a business. There has to be a business wherein they are agreeing to carry on that particular thing, right? So if there is a agreement to carrying on the business, it is required. But if they are if they are holding a certain property just to sell it in future, they have purchased a property as an investment and they are thinking of selling it in future for profit or something like that, that is not a partnership firm. The fourth is there has to be a mutual agency. Mutual agency means if there are three partners, let's assume, and if one partner do something, that the effect of that will happen to the other two partners also. And if the other two partners are doing something, the first partner who is not doing, the effect will happen on that partner also. So they are bounded by each other. He bind them for his action to the other two partners, and the other two partners also bound that particular person with their actions. Okay, so there is a mutual agency that if he do something, who will face the repercussions? The other two partners also. So that is a mutual agency. Third is there has to be a the fifth is there has to be a sharing of profit. Okay, there is an agreement that yes, we are carrying on the business to share the profit and loss of that particular business. They are not doing any charity, right? They are not carrying on any activity for charity. For that they have to maintain the books of accounts in a separate way. Here they have to maintain the books accounts as per the Partnership Act. Okay, this is a partnership firm. And the last is the liability of partner. Liability of partner means if one partner, let's assume, gets into an agreement, he signs an agreement or something, and he become bankrupt because of that. So the other partners also have to pay off their their personal assets as a liability. Like if he becomes bankrupt, if he enters into an agreement, then when there is a time to pay off the liability for other people, then the two partners have to sell off their personal assets also. So the liability of partner, like if one action have the repercussions on other partners also. Okay, so the liability, that is also being mutually agreed, right? So these are the features which we have to take into mind, that yes, the partnership firm has entered into an agreement. Now it's not necessary that it is a written agreement or an oral agreement. They may have decided orally, okay, like I'll bring this much amount of capital, on that capital we will give you an interest. If you withdraw a certain amount, we will charge interest on it. If you do certain things, we'll give you salary. If you promote the business of the organization, and because of that, if the firm is having certain kind of a profit, okay, we will give you a commission. So if this is mutually agreed, there is an oral agreement, it is fine. Okay, Partnership Act says there has to be an agreement. It may be oral, it may be written, but it's better to be safe, right? Okay, so we need to have certain evidence if any disruptions happen between them. So to settle that, it is necessary to have a written agreement. What is written agreement called? It is called partnership deed. It is called partnership deed. Partnership deed means written agreement between the partners. Now what does this written agreement hold? This will hold like what is the name and address of the business, what is the name and address of the partners, how much interest we need to give on the capital invested by the partners. If the partners are withdrawing certain amount, how much rate of interest we will charge on their drawings, how much salary, commission. If there is an admission of a new partner, if they decide to add a new partner, or if certain partner got retired, or there is a dissolution of the firm, how they will manage it. If they are not mutually agreeing on certain things, how to settle that dispute. So all these things are mentioned in the partnership deed. Okay, this is a written agreement wherein all these things will be mentioned. Okay, but let's say if certain things are not mentioned in the written agreement, or if there is an oral agreement and there is no discussion about certain things, then we will have to follow the provisions of the Partnership Act. What the provision says, what the Partnership Act says on certain things, we have to follow that. Let's say they have not mentioned about the profit sharing ratio. There is no such mention in the profit sharing ratio that if the firm earns a profit, how much profit they will share. It's not been mentioned. What they need to do, they need to share equally. Okay, they need to share the profit or losses equally if nothing is mentioned in the partnership deed. Second is about interest on capital. If nothing is mentioned in the partnership deed, they are not supposed to give interest on the capital. The firm, partnership firm, is not supposed, even though there is a profit, but if nothing is mentioned in the partnership deed, then you can't give interest on capital. Okay, similarly, interest on drawings. Interest on drawings, we can't charge interest on the drawings if the partnership deed is silent. Partnership Act says like that. If the partnership deed is silent, we are not supposed to charge the interest on drawings. Next is interest on loan. If any of the partner is giving loan to the firm and if nothing has been mentioned in the partnership deed, so they are supposed to give interest at the rate of 6%. Okay, these things can be asked for, short questions or something like that. Let's say the partnership deed says that you are supposed to give interest at the rate of 8%. Okay, there is a partner who has given a loan worth rupees 1 lakh and the partnership deed says that we are supposed to give rate of interest at the rate of 8%, but the Partnership Act says that you should give loan at the rate of 6%. How much loan you will give? Obviously what the partnership deed has decided. Okay, these things you have to follow. When the partnership deed is silent, it's saying nothing about all these things, then we have to consider this. But if the partnership deed is saying that we have to give interest at the rate of 8%, then we have to give 8,000 as interest and not 6,000. Okay, not 6,000, we have to give 8% interest. If the partnership deed says, if the partnership deed is silent about it, then we have to give interest at the rate of 6%. And the last is remuneration for firm's work. Likewise, I said salary, commission. Now why these things are decided in the firm? They are the partners, they have a share in the profit sharing ratio. Okay, but there are certain partners who are actively involved in the business. Okay, now if there are certain who are silent about it, they are sleeping partners. Now if a person is actively involved, he needs a certain kind of remuneration for that. Okay, so the firm decides, okay, if he is into this actively involved in the firm's business, then they will give a salary, monthly salary to this partner, or based on the sales. Okay, if there is a profit, they will give commission on that profit. Okay, so this is the remuneration or salary or commission which the partners will get if it is mentioned in the partnership deed. If nothing is mentioned in the partnership deed, even though he is an active partner, he is involved in the business, he is not going to get any kind of a salary or commission. So these things have to be followed only and only if partnership deed is silent about it. Partnership deed doesn't say anything, then and then only we will follow this. But if the partnership deed mention anything related to all these things, then we are not supposed to follow it, right? The Partnership Act also says that the partners cannot carry on the same business. Okay, if there is a firm who is carrying on a business of purchasing or selling certain goods, right? Certain let's say assets or furniture, right? The one partner decides, okay, I will do the same thing, I'll carry on the same business. No, he cannot do it. If he is doing it, if he is earning a profit on it, he has to share the profit with the other partners. So these are the things that a Partnership Act says and we have to follow it. Okay, now when we are saying about it, what we need to consider, same transactions will happen, but here what we will need to consider, we need to maintain a partnership capital account. Okay, we need to maintain this. We need to make a profit and loss appropriation account, and if there has been anything which has been missed out in the past, okay, so how to rectification of the past things. Okay, past entries, past transaction, how we will rectify the same. These three things we are going to discuss about it in this chapter. There are other two things like reconstitution of the partnership firm when there is an admission or a death or a retirement of a partner, dissolution of a firm. Those things we will study later. But in this chapter we are going to study about the partner's capital account, profit and loss appropriation account, and rectification of the past errors. Okay. Okay, so let's discuss about the maintenance of capital account of partners. Okay, now let me just revise what we did in 11th standard, right? We prepared trading account. Okay, from trading account, if there is a gross profit or a gross loss, we transfer it to the profit and loss account. Okay, from that profit and loss account, whatever indirect expenses or indirect income are there, we will have a net profit or net loss. Where that net profit or net loss will go? It will get added if there is a profit, or it will get deducted if there is a loss from the owner's capital. Okay, we used to prepare a balance sheet. In that balance sheet there was an owner's fund, and in that capital amount, whatever is the owner's capital amount, we will either add the profit or we will either deduct the losses. Okay, this is what we used to do in 11th standard about the sole proprietorship, right? Now here what is there are partners, so this profit or this loss doesn't belong to only one person. Okay, there are partners, so they will share the profit and loss amongst each other. Okay, now to share the profit and loss, what we need to do, we need to prepare their capital account. Okay, we will prepare their capital account. Okay, similarly in the sole proprietorship, when we were preparing the accounts, what we were doing, we were preparing profit and loss, and whatever profit or loss we used to transfer it. Okay, but now after that profit there are certain things also, right, which which we have to give to the partners, which belongs to the partners, and which we have to take from the partners also. Okay, so that profit and loss account, after preparing profit and loss account, what we need to do in this case, we need to prepare profit and loss appropriation account. Profit and loss appropriation, we earned, the partnership firm earned a profit. Now how we will appropriate that profit? Okay, how we will give the profit to the partners? For that we will prepare a profit and loss appropriation account. In this account, same effects, the effects of interest on capital, how much capital interest we have to give to the partners, how much interest we will charge on their drawings, how much salary we need to give, how much commission we need to give, all these things will be mentioned over here. How we will appropriate the profit which belongs to the partners, right? So these two things we have to maintain. Till this point it is everything same how we used to prepare the profit and loss and trading account, but after that we need to prepare a profit and loss appropriation account as well as the partners capital account. Okay, so how we will prepare partners capital account? There are two ways to maintain the capital account. One is the fixed capital method and another one is a fluctuating capital method. Now when I say fixed capital method, what does it mean? Like when the business started, when the firm, partnership firm started, every partner bring in some or the other form of a capital. Let's say there are three partners, A, B and C. A got 3 lakh rupees, B got 2 lakh rupees and C got 1 lakh rupees. This is the amount of the capital they invested in that particular firm. Okay, so this is the capital they got. When I say we are preparing a fixed capital method, so whatever transactions, whatever profit appropriation is there, profit and loss appropriation is there, we are not going to give its effect in the fixed capital method. When we are preparing their accounts, it will remain fixed, 3 lakhs, 2 lakhs, 1 lakh, unless there is a additional capital being brought by the any of the partners. Otherwise, if they are withdrawing certain amounts, if we are giving an interest on their capital, if we are charging an interest on their drawings, if we are giving a salary or a commission, or we are giving an interest on the loan amount, we are not going to give effect on this. Okay, this will remain fixed unless any of the partner brings additional capital or withdraw its capital amount, not the drawings. If they withdraw its capital amount, or if they bring in certain additional capital, then and then only there will be certain effect on this capital account when we prepare fixed capital method. Okay, for that, what we need to prepare? We need to prepare two accounts. One is partners capital account and another is partners current account. Okay, in this current account, whatever effect, let's say there is this is my profit and loss appropriation account I have prepared, right? So A, B and C. Similarly, in this current account, A, B and C is there. Okay, so profit and loss, whatever profit they have earned, we have to give to the partners. So here, by net profit, whatever net profit is there, we will give it to them. Let's say 30,000, 20,000, 10,000. Okay, if there are drawings, let's say C withdraw 80,000. Okay, A and B has not withdrawn any amount. There is an interest on capital. Okay, interest on capital, let's say we have given 15,000, 10,000 and 5,000 is the interest we have given on the capital. We have given salary to A, so by A's salary we are giving 20,000. So whatever effects, we are not going to touch this capital account. This is a fixed capital account, partners capital account. We need to keep it as it is, but whatever effects related to the net profit, to the interest that we are giving to them, to the salary we are giving to them, to the interest on drawings, let's say to interest on drawings. Now C has withdrawn a certain amount, there is an interest on drawing is 8,000. Whatever effect is there, we need to give it over here. Okay, we are not going to disturb this capital account. Okay, now this capital account will always have a credit balance. This is the capital being invested by the partners in the firm. Okay, so the firm is liable to pay to the partner, so this will always have a credit balance. But this current account may have a credit balance, may have a debit balance. How? Let's say in this case only, what is this? 30, 15, 45, 65,000. Credit is 65,000, credit balance is more, there is no debit balance. So A's account have a credit balance of 65,000, B's account have a credit balance of 30,000. But when we look towards C, there is 15,000 on the credit side, there is 88,000 on the debit side. Okay, so 73,000. 73,000 is what is the debit balance. Okay, so C may have a debit balance of 73,000, where we are going to show on the asset side. Okay, so this current account may have a credit balance or it may have a debit balance. But when we say about the fixed capital account, obviously the capital account will always have a credit balance. Now when I say the second method, what is the second method about? It is about a fluctuating capital method. Fluctuating capital method, no need to prepare this current account. No need to prepare this capital account. Whatever effect we have given over here, 3 lakh, 2 lakhs and 1 lakh. whatever effect, we have to prepare only one account, partners capital account, under fluctuating capital method, and their capital will fluctuate. Here their capital amount will be 3,65,000. okay, A's capital plus all these things, his capital balance will be, account balance will be 3,65,000. in this case it will be 2,30,000. okay, similarly in here it will be 1 lakh minus 73, that is 27,000. this is the fluctuating capital method. We are not going to show the capital as a fixed amount. okay, whatever effects in the profit and loss, whatever profit we are sharing, whatever interest we are charging, whatever salary we are giving, whatever commission we are doing, we will show in only one account, and their capital will fluctuate as the name suggests. Here the capital will remain fixed. We need to prepare their current account, whereas in case of fluctuating capital method, the capital amount will fluctuate. okay, now we will discuss about the profit and loss appropriation account, how we will share the profit, what journal entries we need to give, how we will give the effects. In this way I have tried to explain you, but how we will prepare the profit and loss appropriation account and how we will give the effect of the same. okay, now let's talk about profit and loss appropriation account. Now the firm has earned a profit, let's say. okay, that profit will go where we will transfer? We will transfer it to the profit and loss account. What will be the journal entry for transferring the profit and loss account debit to profit and loss appropriation account? okay, there is a credit balance, we need to close it. We will debit profit and loss account to profit and loss appropriation account. So here we will transfer the net profit. okay, whatever net profit is there, if there is a profit. okay, if there is a loss, where we will transfer? We will transfer it over here by net loss, if there is a loss. okay, this is how we will transfer the profit and loss accounts balance, profit or loss, to the profit and loss appropriation account. right now next effect is what? Let's say there is a we have to give interest on capital. One thing we need to understand, if there is a loss, we are not supposed to give anything to the partners. May it be interest, may it be salary, may it be commission, any kind of a remuneration. We are not going to give anything to the partners. right only and only if there is a profit. Interest on drawings we can charge, but interest on capital, salary, commission, we are not going to give to them. right so let's say if there is a profit, okay, now we need to give interest to the interest on their capital amount. right like if we are giving an interest is what? Interest is an expense. okay, so debit all expenses and losses. Whom we are giving? Who are the receiver? The partners are the receiver. So what will be the journal entry? Interest on capital account debit to partners capital or current account, whatever account they are maintaining, fixed capital method or fluctuating capital method. So interest on capital is an expense to partners capital account. Individually we will give all the interest to the partners. okay, now we need to close that interest on capital account. What will be the entry? Profit and loss appropriation account. Now this is our where we have to transfer all the expenses. right so profit and loss appropriation account debit to interest on capital account will get closed. So what? Sorry, here I'll write to interest on capital, whosoever it is, A, B, C, we will give interest to them, so it will be debited. okay, now let's say they have withdrawn certain amount. We have to we have to charge interest on the drawings. okay, what will be the entry? Who is supposed to give? Partners need to give. okay, so partners are liable to pay. So partners account debit to interest on drawing. Interest on drawing is what? It is an income for the firm. right so credit all incomes and gains. So partners capital account debit, their capital amount will reduce to interest on drawings, and now we need to close that interest on drawings. So interest on drawings account will debit, and where we will transfer it to the profit and loss appropriation account. So all the expenses which the firm has to do, whichever they have to give to the partners, we need to debit it. And if we are getting certain kind of an income from the partners, we need to credit it. So by interest on drawings, in our previous example, C has to pay the interest, so I am writing C only. Now let's say they have to give a salary to Mr. A, right? In our previous example, I said that we give salary to Mr. A, so that salary is also an expense. Okay, so salary account debit, who is going to receive it? Our liability towards whom will increase? To Mr. A it will increase. Okay, so A's salary is an expense. Salary to partners account debit to the partners capital account or current account, and now we need to close it. Where we will transfer that expense? To the profit and loss appropriation account. So profit and loss appropriation account debit to, let's say, A's salary account. Okay, similarly the same thing goes for commission. Commission is an expense. We debit commission account to the partners account, we credit partners account. Now we need to close that commission account. What entry it will be? Profit and loss appropriation account debit to partners commission account. Okay, if there is a loan which any of the partner has given a certain amount of loan to the firm, for that also we need to give an interest. So that interest is also an expense. So interest on loan account debit to partners account, and that interest on loan account will get closed while transferring to profit and loss appropriation account. So to interest on loan account. Okay, this is how we are going to give the effects of all the transactions that we are dealing it with the partners. Profit and loss account, we are dealing with the transaction with the outsiders. Okay, it is the firm dealing it with the outsiders. So whatever transaction are happening, we are giving it the effect in the trading account and profit and loss account. Whatever expenses, whatever income is there, we will show it over there. But now that profit belongs to the partners, right? So the effect of that we are going to show it in the profit and loss appropriation account. So now whenever there is a profit on this, we need to transfer that profit to the partners capital account. What will be the effect? Profit and loss appropriation account we need to close. So profit and loss appropriation account debit to partners capital account, we will transfer it to the balance sheet to the individual partners. Whatever profit they have earned, the firm has earned, we will transfer it to the capital account. If there is a loss, we will close the profit and loss appropriation account and we will transfer that loss to the partners capital, and partners capital account will get closed. So if there is a loss, we will transfer this to partners capital account, and the same we are going to show it in the balance sheet. Okay, balance sheet. I hope you got to know how to prepare profit and loss appropriation account. One thing again I am repeating, this thing will be asked in your questions, that if there is a loss, okay, you are not supposed to give interest on capital, you are not supposed to give anything, salary, commission, any kind of a remuneration to the partners if the firm is incurring a loss. Only and only if there is a profit, then only you will give to the partners, right? Now, how much interest to give, how to calculate the interest amount, like if the partners are bringing the capital at different intervals, how you will consider it, we'll discuss about it now. Okay, so till now you understood how to prepare the partners capital account under fixed capital method as well as fluctuating capital method. Moreover, you got to know how, like, pass the transaction out, will pass the entries in profit and loss appropriation account, right? This basic thing, you know how to prepare these two accounts, right? Now comes the calculation part. Okay, we need to give interest on the capital, we need to take interest on drawings. Now, how to calculate the interest on capital and interest on drawings? First, we will discuss interest on capital. This we will discuss later. Now, interest on capital. Partners have invested certain amount and the firm decided to give interest. Firm decided, okay, there is a partnership deed. It is mentioned in the partnership deed that the capital invested by the partners, on that the firm will give interest. Okay, only and only if it is mentioned in the partnership deed. So first thing you need to remember is mentioned in the partnership deed. If it is mentioned in the partnership deed, then only you will give interest on capital, otherwise no interest on capital. First thing. Second thing, only if there is profit. Okay, only if the firm has earned profit, then only the firm will give interest on capital. If they have sustained in losses, they are not supposed to give interest on capital. So loss, no capital. If there are losses, the firm will not give interest on capital. Okay, and then comes if there is profit. This profit is also, I will say, divided into two things. First one, if there is a adequate profit. Adequate profit. What do we mean by adequate profit? Let's start with an example. There are two partners, A and B. They have invested. A invested 4 lakh and B invested 3 lakh. Okay, their profit sharing ratio is 3:2. Okay, their profit sharing ratio is 3:2. Now they have the partnership deed mentioned that they'll get interest at the rate of 10% on their capital. Okay, so the interest on capital will be how much? 40,000 and 30,000. 3 lakh, 10% of 3 lakh 30,000 and 10% of 4 lakh is 40,000, and the profit that the organization, that the firm has earned is 90,000. So in total the interest is how much? 70,000. So the profit is adequate enough to give the interest to the partners. Okay, they have sufficient profit, right? So now they are left, after deducting interest on capital, they are left with how much? 20,000 profit. This 20,000 profit will be shared between A and B in the ratio of 3:2. That is, he'll get 3/5, he will get 2/5, that is 12,000 and 8,000. This is how it will be done. Okay, 9,000 is the net profit. On that they will give interest only if the net profit is adequate enough to give them the interest, and after whatever they are left with, they will share their profit in their profit sharing ratio. But let's say there is inadequate profit. Now what do we mean by inadequate profit? Let's say the profit is 28,000. Current year profit is 28,000. The interest amount is 70,000. How they can pay off, right? So in this case, what they need to do? They need to divide this profit in the, this is not a profit, they have to give the interest to the partners in the ratio of their capital invested. How much capital they have invested? A has invested 4 lakh, B has invested 3 lakh. So what is the ratio? Deduct this, it's 4:3. This is capital invested ratio. not on the basis of profit sharing ratio, right? Here they are not sharing the profit, here they are giving interest to the partners, so they have to share the interest on the basis of the capital invested. Okay, the ratio that they have to take is capital invested. So this 28,000 will be divided into, you will get 4/7, that is 16,000, and we will get 3/7, that is 12,000. Okay, this is how it will be divided. This is the interest on the capital they will get. Okay, there is no profit will be, then no profit will be left. So you need to understand, if there is an adequate profit, give as per the rate of interest they are supposed to receive. If there is an inadequate profit, if profit is not sufficient enough to give them the interest, then they will divide that particular profit based on the capital they have invested. Based on that ratio, they will give the divide the interest on capital, and not on the basis of profit sharing ratio. You have to mind this. Please don't divide this 28,000 in the ratio of 3:2. This is the interest that they will get. Okay, now in certain cases, what happen, in exams, what happen, you will be given the capital at the end of the year. When we are giving the interest, we are giving the interest at the beginning. Okay, whatever capital for the whole year, we are giving the interest. Now they may give you how we will arrive, like how we show the capital in the balance sheet. The capital in the beginning of the year, this is capital at the beginning of the year. Okay, then if the partner have withdrawn certain amount, we will deduct less drawings, right? We will get this is the capital they invested, this is the drawing they have made, we have to deduct it, we get the amount, and that at the end of the year, whatever profit or loss is there, let's say there is a profit, we add the profit, and what we get, the capital at the end of the year. Capital at the end. Okay, this is the capital at the end of the year. Okay, now in certain cases, you will be given capital at the end of the year, and you are supposed to calculate the interest that you have to give to the partners. Okay, what you need to do? You need to reverse it. You need to first write the capital at the end. Okay, capital at the end, you know that amount. If they have withdrawn certain amount, what you do? You deduct it, but in this case you have to add it to get the capital at the beginning. Add the drawings. Okay, you have to add the drawings. Okay, then what you do, when there is a profit, you add the profit. Okay, so this amount is inclusive of profit, you need to exclude it, so you will deduct the profit. Or if there is a loss, you need to add the loss. Okay, if there is a loss, how can they give interest on capitals? Okay, so no interest on capital. Just to confuse you, I said if there is a loss, no interest on capital, right? Only if there is a profit, then only they will get interest on capital. So we will add the profit. What we will get? The capital at the beginning of the year. Beginning of the year. This is the capital at the beginning of the year. Now let's say the partner brings additional capital in the mid of the year, or let's say in the month of January he brings the capital, so you need to deduct that capital amount. Why? Because on that capital amount you have to calculate the interest for 3 months. Let's say he brings capital in the mid of the year, so you need to deduct less additional capital. Okay, you need to deduct additional capital, and then you will get the capital at the beginning. This is the amount that you will get at the beginning of the year, right? Now this is how you will calculate, and you will get to know capital at the beginning of the year. Now let's say how to calculate when the capital is being given and the partner brings in capital after 2 months, after 3 months, he brings additional capital, or he withdraws certain amount of capital. How to calculate? Okay, now let's say there are two partners, A and B. right? A brings in capital of 4 lakh. This is the beginning of the year and he brings in 3 lakh, right? Fine. This is the beginning. Now B brought additional capital of rupees 1 lakh on 1st of October. On 1st of October, and A brings additional capital, let's say 50,000 on 1st of January. Okay, fine. So now if we want to calculate the interest on capital, let's say it is at the rate of 10%. So on 4 lakh, we'll give interest for the whole year, that is 40,000, and for he brings in for 3 months, like for 3 months we need to give interest. So 50,000, 10% of 50,000 into 3 by 12. How much it is? 1250. Okay, this is the interest on capital that we will give to Mr. A, 41,250, right? Here in this case, how much interest we will give on 3 lakh? We will give 10%, that is 30,000, right? And then on 1 lakh we will give 10% for 6 months. Okay, for 6 months we will give interest, right? So 1 lakh, 10,000 for 10,000 is for the whole year. So for 6 months it will be how much? 5,000. So how much interest we are giving? 35,000. This is how we will calculate. Now let's say they withdraw certain amount. Let's say B withdraw the capital amount worth rupees 50,000, okay, on 1st of Jan. How you will calculate this? In this case you can calculate individually, but in this case what we will do, 3 lakh amount is till how much period? The 3 lakh amount is till 1st of October, that is for 6 months. So for that 10% for 6 months we will calculate, that is 15,000. Okay, then he brings in additional 1 lakh rupees. So this 4 lakh is still how much? On that we will give 10%. This 4 lakh is still how much? From till January, that is for 3 months. Okay, October, November and December, 3 months we are going to give the interest. Okay, so for 3 months it is how much? 40,000 into 1/4, that is 10,000, correct? And then he withdraw the capital amount of rupees 50,000 on 1st of Jan. So they are left with how much now? 3,50,000. On that 3,50,000 we will give the interest for the remaining 3 months. Okay, so 3,50,000, 35,000, 1/4 of 35,000 equals to 5,000 is 8,750. So how much interest we will give? 33,750. That's how we are going to give interest to Mr. B when the additional capital is brought into the business in the mid of the year, when he withdrew the certain capital at a certain point of the time of the year. So we need to calculate in such a way, like this 3 lakh was there in the firm for 6 months, so we will give 10% for 6 months. Then 4 lakh was there for 3 months, so we will give for 3 months. And then 3,50,000 was there for 3 months, then we will give 10% interest on 3,50,000 for 3 months. And that's how we will get to know the interest that we will give on the capital amount, right? So this is how we will calculate the interest on capital. You need to remember that if the capital, if there nothing has been mentioned in the partnership deed, you are not supposed to give interest on capital. If there is a loss, you're not supposed to give interest on capital. If there is a profit, if there is an adequate profit, give the interest on capital, and the remaining amount you need to divide that profit in profit sharing ratio. If there is an inadequate profit, so the profit is not sufficient enough to give the full amount of capital, so whatever profit is that, you have to divide that profit as per the capital they have invested, as per that ratio. Okay, sometimes you will be given capital at the end of the year. How to get to know at the beginning of the year? Obviously that capital amount in the end of the year drawings has been excluded, so you have to add it to get to know at the beginning. As well as if there is a profit, which profit has been added, you need to deduct that profit. If additional capital they have bring into the business, that you need to deduct it, because you need to calculate the interest on capital for the full year, and on additional capital whenever the partner has bring into the business, for that particular period you have to give interest. Okay, and this is how we will calculate the interest on capital. If the capital is being bring into the business in the mid of the year, or they have withdrawn certain capital amount during the year, so that's how we will calculate the interest on capital. I hope you are clear with it, because the interest on drawings is going to be get little bit complicated, but I'll try to simplify it. Okay, so till now we discuss how we will calculate the interest on capital. Okay, the next topic that we will discuss about is interest on drawing, and that next topic I'll discuss in the next video, that is part 2 of the first chapter. I hope you got it till this much. I want you to do practice till this much, so that next topic, when I will carry it forward, you continue practicing with the next topic. Okay, so see you in the next video. Thank you very much.